Just like traffic rules, there are certain rules of money which you should follow if you want to get rich. We will tell you the 10 such rules of money that will make you rich. Without any further delay, let's continue. Number 1. Establish financial objectives for yourself. Prioritize the identification of your short, medium, and long-term goals before proceeding with any other tasks. This exercise, while straightforward and easily done with your feet up, establishes a clear context and purpose for your financial strategy, ensuring you remain focused and avoid misallocating your resources. Establishing your goals promptly will ignite your motivation to pursue them effectively. The 10th rule is very important for you to follow, so keep watching the video till the end. Number 2. Understand your assets and identify your requirements. Regardless of your age or financial status, it is essential to be aware of two critical figures, your income and your expenses. Assess your rent or mortgage obligations, utility expenses, food costs, fuel expenditures, and other essential financial commitments. If you're unable to meet your expenses, it's time to reevaluate your lifestyle choices. Evaluate your desires against your essentials to ensure you make informed choices regarding the discretionary expenses you choose to maintain. You might choose to maintain your Netflix subscription while eliminating your afternoon visit to the juice bar. Families typically squander 16% of their income on non-essential expenditures like lottery tickets and unused gym membership expenses that should be eradicated, according to All Millionaires. This is about embracing experiences and seizing opportunities to explore and enjoy life to the fullest. It's essential to understand your core values. Please subscribe to our channel and also press the like button as it motivates us to make more amazing financial videos for you all. Number 3. Implement a structured approach to saving. Consider savings as a non-negotiable expense, akin to your electric bill, essential and automatic. Implement a systematic approach to saving by establishing an automatic transfer from your paycheck. This strategy ensures that funds are allocated efficiently, minimizing the temptation to spend unnecessarily. Initiating your savings journey sooner allows you to capitalize on interest, ultimately reducing the total amount you need to save to achieve your objectives. This exemplifies the power of compounding, a concept that should motivate even the most hesitant savers. When interest is earned, it is incorporated into the principal, subsequently allowing additional interest to be calculated on the combined total of the principal and earnings. Envision a snowball positioned at the summit of the hill. You initiate the process, and as it accelerates, it expands significantly. That's your investment compounding. Evaluate the implications of investing $10,000 with an annual return of 6%. By simply reinvesting the earnings, your capital will exceed 3 times its original value after 20 years. Following a 40-year period, your account is projected to exceed a valuation of $102,000 based on an analysis conducted by the Vanguard Group. Number 4. Prioritize your retirement strategy. Allocate funds into a retirement account such as a 401k or individual retirement account. These options are structured to be either tax-free or tax-deferred, enabling you to invest pre-tax funds or benefit from deductions on after-tax investments. It is essential to leverage a 401k plan that provides a matching contribution to maximize employee savings. Numerous organizations offer a matching contribution of up to 4%. Individuals with an adjusted gross income below $137,000 and couples earning less than $203,000 should consider investing in a Roth IRA. This strategy enables your savings to grow without tax implications and allows for tax-free withdrawals during retirement. The annual contribution limit is set at $6,000 or $7,000 for individuals aged 50 and above. Number 5. Focus on strategic growth investments. Long-term investments should be strategically positioned for maximum growth potential. This signifies equities. Considering the recent fluctuations in U.S. stock markets, this may appear to be a high-risk proposition. The advantages significantly surpass the disadvantages. Typically, a bull market in U.S. stocks endures for 8.9 years, resulting in stock appreciation exceeding 400%. In contrast, an average bear market concludes after 1.3 years, witnessing a 41% decline in stock value, according to Powell. Historically, every single instance of a stock market decline has been followed by a recovery, ultimately leading to new record highs. Number 6. Steer clear of unfavorable debt. The most challenging step toward achieving financial literacy is often the one that requires restraint. Steer clear of credit card debt, and if you choose to utilize a credit card, ensure that you pay it off in full each month. Some forms of debt, such as student loans or home mortgages, come with low interest rates and facilitate significant investments in your earning potential and wealth. In contrast, credit cards impose interest rates that can exceed 20%. The accumulation of debt can rapidly escalate, undermining your financial objectives. Evaluate the implications of financing a new $1,500 laptop computer with a credit card that carries an 18% interest rate. A minimum payment of $37 will be billed to you each month. Paying only the minimum will extend the repayment period to over 13 years, resulting in a total cost exceeding $3,200. Number 7. Ensure you are not overpaying for any asset. Evaluate the impact of expenses associated with mutual funds and exchange-traded funds, which generally vary from a small fraction of 1% to over 1% of assets annually. With an investment of $100,000 at an annual return of 6%, your capital would appreciate to $430,000 over a 25-year period, assuming no fees are incurred. An annual fee of 1% would diminish your $85,000, resulting in a total of $345,000 remaining. By maintaining a focus on low-cost funds, you will not only achieve savings but also position yourself to potentially realize greater returns. During the period from 2010 to 2015, 60% of the lowest quintile U.S. stock funds outperformed their benchmarks, in contrast to only 20% of funds in the highest quintile for FEs. Number 8. Ensure your safety. Life presents challenges: job loss, injury, natural disaster, theft. These unforeseen circumstances can pose significant physical and emotional challenges, as well as lead to substantial financial repercussions. It's essential to prioritize insurance options that may not be mandatory, such as renter's insurance and disability insurance. Investing in these protections is a strategic decision for your financial security. While your employer might offer disability coverage that replaces up to 60% of your income, it's prudent to consider additional layers of protection as your life evolves with marriage and children. For those with dependents depending on your income, securing term life insurance is essential. Number 9. Simplify the process. For most investors, especially those who are just beginning their journey, the optimal strategy is to adopt a straightforward, cost-effective, diversified portfolio of index funds that aligns with market performance. Focus on a long-term strategy rather than attempting to outsmart the market. Disregard fleeting advice and monitor your returns with a disciplined approach. Maintain a clear separation between your emotions, political views, and instincts when making investment choices. Recognize that the moments you feel the strongest urge to sell often indicate it's the optimal time to consider buying, and the opposite holds true as well. It is advisable to steer clear of speculative investments such as cryptocurrency. Consider the potential risk that trends may reach their zenith just as you make your investment. Recall the hype surrounding 3D printing and its anticipated dominance. Furthermore, specialized investments can suffer significantly if a mass exodus of investors occurs simultaneously. In financial terminology, this situation is referred to as a lack of liquidity. To mitigate this issue, it is advisable to focus on established, reliable indexes like the S&P 500. Number 10. Pursue impartial counsel. Ensure that your advisor is fully supportive of your initiatives. Seek out professionals who prioritize your interests and maintain a commitment to transparency, steering clear of any conflicts that may arise from commission-based sales. It is essential to ensure clarity regarding fees. A fiduciary generally imposes a fee that is either a percentage of assets or a fixed rate for individual sessions. Seek out reputable designations obtained through rigorous educational programs and continuous professional development, such as CFP Certified Financial Planner or CFA Chartered Financial Analyst. When evaluating independent advisors, eliminate those who do not utilize a third-party custodian for asset management. It is advisable to consult the Financial Industry Regulatory Authority (FINRA.org) for a comprehensive history of complaints or disciplinary actions. Thank you for watching the video till here. Please subscribe to our channel and also press the like button if you want to know about more financial topics.